calculating the impact of breaking a mortgage. Now, this example is lengthy, so you're just going to have to bear with me through it. Dudley has 18 months remaining in his 5-year term. His current mortgage balance is $445,000 with an equivalent interest rate of 7.2%. The amortization period is 25 years, therefore he has 21 and a half years remaining in his mortgage. Dudley is considering breaking his mortgage because another lender offered him 6.5% interest. He wants to lock in the new lower rate for a 5-year term. He also hopes to lower his monthly mortgage payments to free up some surplus cash flow. He would like to maintain his current amortization schedule and have his mortgage paid off in 21 and a half years, or 258 months. Dudley's current lender will charge him a prepayment penalty of $7,500 to break his current mortgage. He will also need to pay $1,500 in administration fees to set up his new mortgage with a new lender. The total cost for breaking his mortgage is $9,000, which is the $7,500 cost to break his mortgage and the $1,500 cost of administration fees for his new mortgage. Now, Dudley does not have savings available to pay for these costs, but his new lender will allow him to amortize the prepayment and administration costs over the life of the mortgage. Dudley wants to compare the cost of breaking his mortgage to the potential interest savings over the remaining amortization period before making his decision. All right. So let's calculate the cost of his current mortgage first. So just in case you forgot, his current mortgage has a 7.2% equivalent interest rate. So let's go ahead and input this. So let's clear this. Second function alpha. Okay, so the present value is $445,000. That's the present value of his mortgage. And the interest rate is 7.2 divided by 12 because it is monthly payments over 21 and a half years times 12, because again, monthly payments. The future value is 0. And let's compute the monthly payments. So it's $3,395. So Dudley's total payments over the amortization period is going to be $875,910, which is the $3,395 of his monthly payments times the rest of his mortgage, which is 258 months. So 395 times 258 equals $875,910. So therefore, the total interest cost over the amortization period is $430,910. And you calculate that by the total interest, or the total amount of mortgage based on what the present value is. So this is how much he's going to pay over 25 years minus what is the current value of the house. $430,910. Now let's calculate his new mortgage with a 6.5% equivalent annual interest rate. So the present value of this mortgage is $454,000 because if you remember, he has $9,000 in costs for breaking his mortgage and getting a new mortgage. So you include that into the present value because the lender is letting him add this value on to his present mortgage. So that's the present value. And the interest is 6.5%. because that's what the new lender is offering him, divided by 12 because of the monthly payments. He wants to keep the amortization period the same, so it's 21 and a half months times 12. 21 and a half years times 12 months. And the 0 future value. And the PM, his monthly payments are $3,271. So Dudley's total payments over the amortization period is $843,918, which is this amount, which is his monthly payments, $3,271, times the 258 months he has left in his mortgage. So over the next 258 months, his mortgage is going to be $843,918. The total interest and penalty costs over amortization period is $398,918. And you calculate that by subtracting his current mortgage amount by what he ends up paying over the amortization period. So it's $843,918 minus his mortgage amount, $445,000, equals $398,918. Right. So assuming Dudley's interest rates remain stable, he will save $31,992, which is $430,000, which is the cost of his current, the cost of the interest over his current mortgage, $43,910, minus the cost of the interest and penalties over his new mortgage, $398,918,000, is $31,992. So assuming Dudley's interest rate remains stable, he will save $31,992 in interest costs over the life of the mortgage by refinancing, even after factoring the $9,000 costs of breaking and refinancing his mortgage. So lots of information, but overall, despite the fees, his new mortgage will cost him less in the long run than his current mortgage.